Hello, Steve McClatchy here from Loans Australia, the multiple property experts. We're here today to talk about an introduction to investment structuring and how we need to do that to optimise your chances of building your portfolio. What we're going to talk about today is a strategy called cross-collateralisation. This is a popular form of structuring the banks use. We're going to use our little whiteboard here to explain these concepts so you can understand them more thoroughly. When we go to a bank and you've bought a property, you've got already your home, you've bought your first investment property, one of the things the banks like to do is to minimise their risk. And how they do that is very simply, if you've got your house here, it's worth $600,000, and you buy your first investment property for $400,000, over here you owe $300,000, and let's say you need $420,000 to complete this purchase, with all your stamp duties. The banks generally take both of these properties as security. Then you've got the first loan of $300,000 and loan 2 at $420,000. That's all nice and easy, very simple, written on the loan documentation. You've got two loans of the two securities, and it's nice and easy as pie, and that's what the banks like doing. Now, this doesn't always work out the greatest for the investor. A couple of reasons it might not be a fantastic strategy for you is that, let's say another 12 months down the track you want to buy another investment property. You come back to the same bank, Bank X over here, you say, okay, Bank X, I've just went and bought another property. This property is $550,000. And this bank might say to you, oh, sorry, Johnny, you can't afford it. Your borrowing capacity now has changed. You can't afford to borrow this, and we can't give you the money. What happens if you've already signed a contract? It was a great deal. You signed a contract, and you've got no unconditional finance clause in there. You'd be stuck with that property in a whole heap of trouble. So what you need to do, one of the downsides of this structure is if this bank has all your security and they say no, you can't move forward, then unfortunately what you've got to do is try and unravel some of this mess, and it could be in a very short space of time. And we've found a lot of clients doing this and get very stressed because somehow they've got to unravel this and maybe take one security away, or what do they do basically? Their hands are in the air. So what we like to do is to try and make our clients' lives easier and understand you up front the first time. So if we know that you're going to be buying multiple properties and that's your strategy, this crossing of them or using both properties as security is not the ideal structure. I will tell you when it is the ideal structure in a little while, but the best way to move forward would be when you buy this first property, you would set up a second facility on it. A lot of people call it a line of credit. It doesn't have to be a line of credit. That's just an easy name for a term. But it's basically going to have your equity available for you as deposits for future purchases. So if this is the first property over here you're going to buy, instead of borrowing $420 there, you're going to borrow between 80 to 85% of the value of this property, which is somewhere between $320,000 to $340,000. Ideally, we want to avoid mortgage insurance. Most of our lenders will only lend you up to 80% with no mortgage insurance. We do have one or two who'll go to 85% with no mortgage insurance on a purchase, which is good. So you look, based on your scenario, look at what way we can go. Sometimes though, you may have to go into mortgage insurance. And if you've got a higher risk tolerance and you really want to move quicker, then we will go high on this property so you can get your next property quicker. That's an individual discussion situation. So let's just say we borrowed $320, but we needed $420. We need $100,000 over here. So out of this property here, the first loan over here would be $300,000 for your home. The second loan, we'd take out $100,000 here to be used to purchase this property. So all of a sudden now we've got a different structure. We've got one $300,000 loan against your home. We've got a second facility here for $100,000 secured by your home, but for the purchase of your investment property. Now just so you're 100% sure, because the purpose of these funds are to buy an investment property which is income producing, this interest on this loan is fully deductible. So you don't have to worry about that. Just because it's secured by your home, it's still deductible. Against this property, we're going to have an 80 to 85% loan against this property to avoid paying mortgage insurance in most cases. That way, you're actually going to end up with 3 loans. So let's go back to our first scenario. You go back to the bank, you bought the new property. Now this time, if the bank says no, you've got a few options. You don't have to unravel everything. You don't have to go with that same bank. So here you might go to Bank Y. Now Bank Y, we're only looking again to borrow 80 to 85% against this property with Bank Y. So no longer are we securing all of this with the same lender. We've got different lenders as we go along. And one of the best benefits of that is that we don't have to untangle all your structuring once the bank eventually says no. They may not say no for your fifth or sixth property, but then it's even more of a nightmare. You've got 5 or 6 properties all jumbled in together to try and unravel. And sometimes in a short space of time you've signed a contract. So when you're at bank Y, you're only getting 80 to 85% there. So again, you need your 20% plus costs or thereabouts. So you might need $120,000. And that $120,000 will come out of your line of credit up here. And you could have multiple accounts, we won't go into all that now, but it basically comes out of this facility up here. So when we're first setting up the facility on your home or first investor property, or either way we do it, again we're looking to set up a facility of between 80 to 85% ideally. This just depends on your situation. We've got many clients who will go up to 90 or 95% if they can, because they know the quicker they get into property, the quicker they get the benefit of the cash flow and the capital growth. So it just depends on your situation. So they're using this as their deposits to buy their properties as they move forward. We'll go into further videos and we'll talk a bit more advanced strategies of what we do. Here I just wanted to explain to you the basics of cross-collateralisation. That doesn't always work. Now I did mention at the beginning there is a situation where it does work. When the situation is when you don't have much equity in your home and you need to get into the second property, you may not have any choice, at least for that first investment property, to utilise the security here. You just might not have enough, so you need to do it. And in some cases also, we do maximise your interest savings the bigger the debt we give a bank or a lender. So we will look at that on a case-by-case basis, but ideally we want to keep it separate, the securities, and not have it linked. And ideally, as we build a portfolio, we try and use different banks as we go along as well. That gives you more leverage with the lender. Quite often we've gone back to a bank and said, look, if you don't give us a better deal on this interest rate here, we're going to move you to one of our other banks down here. And a lot of the times that does work, especially when the banks at the moment are so greedy for more business. So their profits are 5 or 6 billion, they want to get to 10 billion, but at the moment they're doing anything they can to buy new business, which is great. So just to summarise in this introduction to cross-collateralisation and investment structuring, we try not to tangle them together. We maximise our leverage at day one. We do that because the best time to borrow is always now. We don't know whether the interest rates are going to go up or down, but if interest rates go up, it actually means you can borrow less money. So when interest rates are low, that's when you want to set your portfolios as to maximise your future growth. So we borrow 80 to 85% to avoid mortgage insurance if we can. We keep them separate, so if the bank comes back and says they won't lend to you, we can go to another bank easily and just pull a deposit out of your main driving bank. So Steve McClatchy from Loans Australia, the multiple property experts, introduction to investment structuring. Thank you.